lenders, what they're looking for on the property side of things are your loan to value. That's what they're qualifying you for. That's what the underwriter, when they say, oh, your loans and underwriting, they're looking at your loan to value. There's other factors, but the main thing that they're looking at as far as what determines risk is your loan to value. Okay. And your loan to value is your loan amount versus what the home is valued. Loan amount divided by home value. All right. Now, when you're doing a home purchase, okay, and let's share the calculator again. When you're doing a home purchase, and let's say you're buying a home for $500,000. All right, and you want to put down 20%. That'll be 100 grand. All right, so your loan amount would be 400,000, and your value is going to be 500,000. All right, that gives you an 80% loan to value. Okay, you have $100,000 of equity in the home, which in this case would be 20% equity. Banks, their rule of thumb is 20% or more is in the green. You're good when it comes to loan to value estimate. So think about it. We see a lot of homes that are $500,000 homes. In order to be considered less risky, you need $100,000 to buy that house. So let that sink in and process that. That's where banks are saying, all right, this is not a risky person. And they want it as lower under 80% as possible. Okay. But a $500,000 home, you're going to need about 100 grand to have a 20% down payment. All right. Now, let's say, how much was that house we just looked at? Let me pull that up real quick. Because I believe the home we were just looking at, it wasn't that much. By that much, I mean, it wasn't 500,000. Yeah, it was 189.9. All right. So, and let me share this screen real quick. Well, actually, so let's take a look at this one. Okay. Let's take a look at this one. All right. So on this home here, it's 424,000, right? It's $424,089. It's in Jacksonville, Northeast Jacksonville. Okay. It's not bad. All right. These look like some AI photos, though. It's not, doesn't look real, so I'm assuming they're just building it. I don't know. But they're estimating the loan payment would be 2,845. That's interesting. But yeah, that's based on somebody, I'm assuming, putting down 20%. So here's a breakdown right here. This is why I do like realtor.com. I believe Zillow does it also. But the interest rate, they can't stand on that. They can't stand on 6.6. It probably is in that ballpark, but they can't stand on that. You need to speak with a real mortgage loan officer to verify that in real time. Okay, because the mortgage rates change throughout the day. So you want to verify that in real time. But taking a look here, right? Um, this is the purchase price, 424.89. Interesting. But to put down 20%, this would be 84,000, 818. So we're gonna round that up to $85,000 you need to put down. All right. And you see total due out of pocket. They're estimating 101,782. And that's for buying a $424,000 home. All right. This isn't for a mansion. You need $101,000, roughly 102,000. Estimated closing costs, which is that's pretty accurate. 4%. That's 16,964. $17,000 in closing costs. All right. So inflation isn't just hitting the grocery stores, it's in the mortgage market too. All right. Now, this is if you wanted to be considered a strong profile and put down 20% or more. All right, so let's look at what that LTV would be, which it should be 80, but loan amount 424. Well, this is the purchase price minus 84,818. So the loan amount that you'll be working with would be 339,271. All right, and when you divide that by 424.89, you get 80%. That'll be your loan to value. Now, let's say on this house you're looking at doing a 3.5% down payment, right? You're gonna do 3.5%. It's $424.89, and you want to do a down payment of 14. You'll be looking at a down payment of $15,000. Okay, $15,000 to buy this house. That's a minimum payment, $15,000, and your LTV is going to be 96.5%, which is going to put you more than likely in the FHA zone. It's more than likely going to put you in FHA to buy this house, and you'll still need 15,000, and the closing costs are still going to be the same, if not more. So let's do the math: 15,000 plus 17,000. You're going to need $32,000 to get this on FHA, and that's estimated, but you need about $32,000. All right, you need about $32,000. Okay, and this is in Jacksonville, Florida. This isn't in Los Angeles. This isn't in San Francisco. This isn't in New York. You're gonna need $32,000. $32,000 out of pocket, roughly. You'll probably need a little bit more than that. Your payment is going to be a lot higher than this because you're not putting 20% down. So the less you put down, the higher your mortgage payment will be. All right, it will be higher, and we can break down how much higher it'll be if you all want to look at that. That's perfectly fine with me. Perfectly fine. If you want to break that down, we can look at that. There's no problem there. We can break that down. Let's see if I can pull that up for you all. All right, let's take a look here. Um, can I use this one? I don't typically like using this. Here's what we'll do. Let's pull up mortgage. I like to use my own mortgage calculator, but I'm not gonna lie, my battery on it is out, and just haven't gotten around to get another one. But I have a tool that I'll be showing you all soon that we can calculate that rather swiftly. All right, so how much was that house again? We'll just say 425. There's all that $89 jazz. It's whatever, man. All right, so let's take a look here. 425. We're gonna do 3.5 down. Your loan amount will be 410, 125. Let's be a little more realistic. All right. Yeah, I don't want to do that. I want to do this. All right. So your mortgage payment is going to be, hold on. So your mortgage payment is going to be 3,343 a month. All right. Keep in mind DTI again. So if you're only making 6 grand a month, you're already well over 50% with just a house payment. We haven't included an auto loan, credit cards, any other debt that would be included on your debt to income. This is just a house. So if you're making 6,000 a month, 3,300 is well above half of your check. So you're already in the risky side on DTI. You're already in the risky side on LTV. Your loan to value is 96.5% because you're only putting down 3.5, the minimum requirement. So you're risky in 2 out of the 4 areas already. You're risky in 2 out of the 4 areas already. All right, down payment would be roughly 15,000. Okay, plus your closing costs, which we said was about 17,000. So you need $32,000. Your payment's going to be almost 3,400 a month. All right. Now let's say you even get a good rate. Let's say you get a 5.99. Let's calculate that. Let's calculate that. You're still at 3,000. So if you're making 6 grand a month, you're still at 50% DTI. You could possibly still do FHA. It's gonna be a tough one though. But we may be able to make FHA work. Where the problem's gonna be at, where's the reserves? So you're gonna need to have strong reserves. Using a gift and all that is good. So you're gonna have to have all hands on deck. You're gonna have to have all hands on deck because look at this payment. It's still $3,000. All right. And the rule of thumb is you want to be under 45%. You're still at 50 right here. This is 50%. All right. So keep that in mind. You want to make sure you're compensating for if you're weak, or as lenders would say, risky in one area, you want to be strong in the other three to balance that out. So if you're risky in the down payment, which is the LTV side, remember, a strong LTV is considered 80%. That's 20% or more equity in the home. So if you're at 3.5%, you're automatically considered risky. That's considered risky. All right. So you want to have strong debt to income. You want to have strong credit. You want to have strong assets. Again, you don't want to have any insufficient funds, no bounce checks, no large deposits. You want to make sure your assets are good in that area, and you also want to make sure that you have some reserves. Okay, because you're having a low down payment, you want that 3 to 6 months reserves so you can strengthen out the rest of that profile. All right, because a low LTV is a sign of risk to lenders. That's a sign of risk. All right. Now we saw what a 20% is. Let's say you wanted to put down, you don't have the full 20, but let's say you got 10% you want to put down. All right. All right, you're putting down 10%. So your down payment is going to be $42,500 for this home. 42,500. All right. With a 10%. We're going over LTV right now. Okay, that's a 90% loan to value because you put down 10%. So your LTV is 90%. Still considered risky. Better than 3.5, but still considered risky. All right. You're still gonna need about 17,000 to close. So that's $59,500. That's roughly 60K that you'll need in the bank. Again, you can leverage your 401k. You can leverage your 403b. You can leverage your thrift savings plan. But these would be considered a riskier loan to value ratio. Now, in order to get a Fannie Mae or Freddie Mac home, they do have programs. I believe with Freddie Mac, it's called the Home Possible, where you can put down a minimum of 3%. But your debt to income cannot be 50. Your debt to income needs to be around like 38%. Okay, conventional, if they're gonna, the conventional likes, like Fannie and Freddie like big down payments. They love big down payments because you're putting that ownership into the home. You're less risky because keep in mind, all the ownership you have in the home, that's your money. So you can leverage that when you need to. So they like that because they know you have access to assets. So the larger down payment you make, the stronger your profile will appear, the better chance you have at that approval. All right. But a strong loan to value is going to be 80% or less. 80% or less. You want to put down as much as you can if you want to be strong in loan to value. Now, if you want to put down a lower down payment, by all means, I've done a ton of them. I'm not against it. I'm not against it at all. I'm not against it, especially if you feel the value in those areas will be increasing. Yeah, I'm not against that at all. But keep in mind, you will be flagged as a riskier applicant as it pertains to your loan to value. But if your other compensating factors are strong, then you're good to go. You're good to go. You are able, you are allowed to put down 3.5%. If you're a military vet, you can put go zero down. And there are down payment assistance programs out there that will allow that. Okay, so keep that in mind. We'll probably touch on those at some point, but right now I just want to go over how to complete a mortgage loan application. Okay, that's what I want to discuss here. And I also want it to be hands on so you can realistically see what you're looking at here. But your loan to value is what's required when they talk about qualifications on property or real estate. They're looking at your loan to value, how much equity you'll be having in the home when it closes. And again, we've gone over it time and time again, but I'm going to repeat it. I'm going to always repeat it. Equity is your ownership stake in the home, it's how much you own. In percentage, that's your LTV, loan to value. And dollar amount is however much that dollar amount is. Okay. And a strong LTV is 80% or less. The closer you are to 100%, the closer you are to being underwater on your home. That's what underwater is when you're above 100%. When the amount of your mortgage is more than the value of your home. So you don't want to be in a position where that could happen. So putting down as much as you can is always going to help. That's why Fannie Mae and Freddie Mac do like to see you put more down on the home. That's why they like that. They like that. That's why they like that. Okay. So keep that in mind. Keep that in mind. All right. So as far as property, LTV is what's used as far as qualification goes. Real estate owned, and that's LTV on other properties you may own. When it comes to property, when you're buying a primary home, this is the rule of thumb. Now, if you're buying a home that you want to rent out, you are required to do 20%, because that is an investment home. That home's sole purpose is for investment opportunity. So you must put down 20%. So this 3.5% that I'm discussing, this zero down, that's for buying a primary home that you're going to live in, owner occupied. If you're buying an investment home, there is none of that jazz. Because now you're trying to be a businessman in realty. So you're going to need to put down the 20%. If you're buying a 2-unit home, you're going to need more. You're typically going to need about 10%, 2, 3 units, because most people who are buying a duplex or a triplex or quadplex, you can't live in 3 places at once. So you're probably renting those other options out. But you usually can get those at 10, 15%. But you're going to want about 20% down when you're taking that route. All right, so keep that in mind. This is for single family primary residences that we're going over right now. Okay, with that 3.5%, 3%, less than 20% options. Now, you can take a look here. This is called mortgagecalculator.org, and you can play around with this mortgage calculator. You can play around with it. Like I showed you here, where we went on realtor.com, and you can look at homes that you like, and you can come over here so it can be a little more realistic. Hold on. Yeah, let me make sure I had it right. So it'll be a little more realistic so you can see. All right. So you can see. Now, these are all estimates, they're not etched in stone. All right. But this is what you're looking at mortgage payment wise, almost 3,000 a month. So remember, income, property, assets, and credit. All right. Income, property, assets, and credit. The property, what they're looking at is how risky you are as it pertains to your loan to value. Again, loan to value is the loan amount divided by the value of the home. If you're buying a new home, the value is the purchase price. That's the value. It's the purchase price. That's the value of your home, is the purchase price. Okay. All right. So in order to look at purchase price, it's whatever you're buying the home for. And however much you put down, that remaining amount is your loan amount. It's simple. These are simple things. These are simple things. These are simple things. All right. So to have a strong profile as it pertains to loan to value, you need to be 80% or lower. I can't say that enough, because loan to value is something that's missed a lot.